Although it was the market leader until the summer when it collapsed, Nvidia was now the price objective. What do we now require from it? In any case, Nvidia is a prominent company and remains at the forefront of the shift that is coming with AI. Long-term investors should, in my opinion, use Nvidia's congestion and consolidation as chances to increase their holdings if they aren't already. Furthermore, I believe that for everyone else, this is just a time to exercise patience, as stocks naturally don't rise in a straight line. Tom, what other selection from your portfolio would you like to leave our audience with? Name or sector? Yes, I believe that industrials and financials are one sector that, if someone has a lot of technology, I believe has a corresponding benefit to many things happening with the Fed cutting. Michael kind of brought this up. Since they will be significant benefactors of a soft landing economy with the Fed lowering interest rates, I believe that if we're looking at market breadth, companies like XLF and XLI or regional banks like KRAE make a lot of sense. John, the stock market has demonstrated its character over the past 6 weeks, as it has done throughout the year. This year, the S&P is exceptionally robust. It has been up for 9 out of 10 months now. And you are true that we were duped by seasonality, since I assumed that there would be a greater chance of a reversal between now and election day. You don't want to sell stocks, was what we said. Since we stated in the same line that you should buy that dip if it does pull back, I believe that panic selling is always a mistake. And until after election day, I believe we're still in that precarious situation. However, that does not imply that I believe investors should be pessimistic at this time. We have a solid foundation in my opinion. Look, if David's assessment is accurate, the economy would benefit greatly from a 3.5% 10-year rate. I'm sorry, a 3% Fed funds rate. It will significantly lift the housing, car, and durable sectors out of the recession, which should benefit P/E multiples as well as profits growth. Therefore, all of this seems like a fantastic background to me. However, that does not preclude the possibility of turbulence. Therefore, I suppose that people consider the possibility of caution to be a bad word. It shouldn't be. People should be ready to buy dips if they occur since this is a stock market. Yes, Tom, you're right. We're approaching the 2 weeks of the highest earnings season. In addition, we have this election coming up, so investors will need to keep an eye on the next weeks. However, you just brought up housing, Tom, and because you're optimistic about home builders and claim that there is historical precedent for this, I would like to hear your thoughts on it. The Fed would seem to be talking in that direction after all. In terms of rate decreases, they did not want consumers to become very thrilled. However, now that they are present, they appear to be indicating that they are somewhat on a course. That's correct indeed. However, the reason we brought attention to the trade today is that, as you may know, home builders have been entering a golden 6-month window since 1999. At Fundstrat, we've been writing about it for almost 10 years, and the trade has been successful for 12 of the previous 15. Home builders have outpaced the S&P by an average of over 1,900 basis points between October 20 and April 29. Therefore, those 6 months are usually when home builders make all of their gains. The backdrop is better today, since the Fed is reducing at a time when demand is pent up, and home builders have actually done a pretty good job of capital management. I'm not sure how to explain the seasonality. Therefore, it appears to us that this year's trade should be successful. It does lead us to our discussion of the tape, which includes the market's next move and the veracity of this bounce. Naturally, we're all curious, so let's ask Tom Lee. He does now live with us. Greetings. Seeing you is pleasant. Scott, it's great to see you. You imply that the worst is over when I look at your notes from today. Why do you think that? The VIX spiked to 60 on Monday, the third highest reading ever recorded, and I believe that's what we're watching. The idea that the same individuals who planned a $3 trillion economy are too stupid to realize the investments they must make in order to generate the next $3 trillion in value never ceases to astound me. In my opinion, individuals are cautious if they believe that P/E indicates the peak of stocks. However, I believe that the P/E is increasing because American businesses and the economy have weathered a stress test, Scott. We had a pandemic, a worldwide halt in commerce, a massive inflationary cycle, and the Fed's fastest rate hikes ever. Assume that businesses are making record profits as a result of the four factors that just blasted corporate profitability. They passed a stress test, which, in my opinion, justifies larger multiples. Personally, I don't think 20 times or even 25 times is that much for a company that leads its category. Additionally, if we're discussing Nvidia, what do you know? Why? I'm not sure. Yes, 30 should be the upper limit. P/E's are increasing, therefore, I believe that's why we're feeling uneasy. But I also believe that businesses have successfully weathered four catastrophic stress tests. I believe we want to know the return on investment for their investment. Like everyone else, they are curious about the amount spent. After you return to their primary customer business, we would like to know the return on investment. Their primary search, which is evidently on some level this dynamic, may be in danger, but it is still anticipated to expand. According to consensus, the street is at 12.4%, and the EPS line is expected to increase by about 13.5%. It takes you to a spot where, in my opinion, Google should be the most guarded of all these names given the numerous references to itself. You see, if this stock is trading at 20 times the EPS, which is where the street is, it is a $200 stock, and I find that to be an intriguing aspect. How has the positioning been going into this crucial earnings week, M? Optimistic. Actually, I'm bullish on almost all of them. Yes, indeed. Let's start with the fact that Nvidia traded 4.7 million contracts out of 55 million contracts that day, including index and ETF options. However, calls are significantly outnumbering puts in each of these names. It's likely that there will be twice as many bets on the upside. Additionally, I believe it's more a matter of being cautious about how far the stocks have come, with Nvidia perhaps being the most prominent example. What multiple we attribute to this, I suppose, depends somewhat on your expectations, but for the entire year 2025, I'm looking at maybe $4 per share. Thus, we will reach 35 times in the upcoming year. It doesn't seem like a lot of money. That represents an annual rise of over 40%. Therefore, the PEG ratio is less than 1. That's growth at a fair price, I mean. How about semis? We brought up Nvidia. As you can see, it's putting Apple at the top of the market capitalization ladder. Although it has undoubtedly had an amazing run, not all of the stocks in this market are Nvidia. How do you evaluate the semifinals? This is the one location where I firmly believe you have witnessed leadership truly fracturing or splitting. And this has been the case throughout the spring, summer, and fall. We are aware of the Nvidia chart's excellence. We are aware of Broadcom's excellence. AMD's where? Lam Research is where? ASML, where are you? Samsung, where are you? You know, it has to do with what is thought of as leadership. It's the weakest, but I believe it's the fastest. In reality, just 25% of semis are above their 200-day moving average at this time. In the upcoming 4 to 6 weeks, semis do provide some decent seasonality. In the semifinals, I believe I would be more likely to fade a bounce than to chase it. I questioned you about Burry shorting Apple before, so now I'll ask you about Nvidia's recent inclusion in the Dow and your thoughts on it in light of your observations over the years. Indeed, on some level, the Dow may have felt somewhat out of step with the current state of the economy due to the prior inclusion of Intel and the lack of a play on Nvidia, which accounts for 7% of the S&P 500. One could argue that it is simply clinging to a high momentum play after it has already made its biggest gains. I was just examining the current market capitalization comparison between Nvidia and Apple. Nvidia, however, has roughly a third,